Technological advancements are on the brink of bringing a revolution in the agriculture sector. Investments in the agri-tech space have skyrocketed in the past 5 years. With the increase of digital savviness among newer generations of farmers, new advancements are getting great hype. On the other hand, the Russian invasion of Ukraine, like every other sector, has also impacted the agri-tech sector. Inflation and supply chain disruptions have resulted in a surge in all commodity prices including pesticides, fertilizers, seeds, and even food. With Russian and Ukrainian supplies out of the equation, U.S. and Canadian agri-tech firms are now in the spotlight. Hence, it is high time to invest in agri-tech stocks with strong fundamentals, as this sector is expected to reach its peak in the days to come. Thus, here we have compiled a list of the 5 best agri-tech stocks to invest in right now. Up first on our list of agri-tech stocks is a US-based food technology company, Benson Hill Inc., trading under the ticker symbol, BHIL. Benson Hill works on unlocking the natural genetic diversity of plants. Its CropOS technology platform uses artificial intelligence, data, and advanced breeding techniques to deliver optimized crops like soybeans and yellow peas. Combining data, plant and food science, the crops are optimized for food, ingredients as well as feed products. Benson Hill has been continuously working on expanding its business. Earlier this year, the company made its entry into the Northern European aquafeed market. This was made possible by a strategic alliance with a leading protein producer in Scandinavia, Denofa. Following this, Benson Hill also entered into a long-term strategic partnership with ADM, which is a global leader in nutrition products and alternative protein. Benson Hill expects this deal to vastly increase the commercialization of its ingredients for plant-based foods. In addition to this, the company has also inked a deal with the grocery chain, Schnuck Markets, to expand the commercialization of its latest soybean-based cooking oil. Moreover, the financial standing of the company also seems very bullish. The latest earnings report of Benson Hill surprised analysts in a much positive way. Its revenues jumped up by 179% year-over-year, to $110.7 million, exceeding analysts' expectations by 31%. On the other hand, statutory losses of 15 cents were much smaller than expected as well. The company now expects full-year revenue to be $340 million to $400 million. All in all, Benson Hill is an outstanding stock in the agri-tech sector to buy right now. Next up on our list is a crop productivity solutions provider, Bioceres Crop Solutions Corporation, which trades under the ticker symbol, BIOX. The company operates through seed and integrated products, crop protection, and crop nutrition segments. It also develops seeds under its HB4 program, which is a drought-tolerant seed technology program. Last month, Bioceres Crop completed its merger with Maroni Bio Innovations, in an all-stock acquisition worth $207 million. Renamed ProFarm, Maroni Bio is a growth-oriented agricultural company, with a focus on environmentally sustainable farming. This merger resulted in Bioceres being a global leader in sustainable agricultural solutions, on top of being a leader in crop productivity solutions. That's not all. The company just recently commenced a long-term collaboration with Syngenta Crop Protection's seed care business. The collaboration will focus on developing and commercializing innovative biological seed treatments. On the financial front of things, Bioceres delivered a record performance in fiscal 2022 which ended on June 30th. The company's revenues shot up by a nice 62% year-over-year, to $319.3 million, in the period while still excluding the ProFarm metrics. This year also marked the first time revenues of $12.4 million, from Bioceres HB4 wheat. Additionally, the baseline adjusted EBITDA went up by 24%, and gross profit grew by 45%. Given the fact that these figures exclude the ProFarm metrics, and still prove to be remarkable, Bioceres seems a stock not to miss. The ProFarm acquisition is expected to further its expansion and cut huge costs in synergies. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Following next is a nitrogen fertilizer manufacturer, CVR Partners LP, which is represented by the ticker symbol, UAN. Its primary products urea ammonium nitrate and ammonia, are used to improve the quality and yield of crops. The company also operates a petroleum coke gasification business, under its CVR Energy segment. This segment produces fuel-grade syngas for power generation and industrial use. The macroeconomic conditions sparked by the Russian invasion of Ukraine, have created a much more favorable environment for the fertilizer business. With the world's largest supplier of fertilizers out of the equation, fertilizers demand and prices are surging. This resulted in solid operating results for CVR Partners in the second quarter of 2022. The company generated net sales of $244 million in the quarter, against the comparable $138 million. Furthermore, the bottom line improved to $118 million, from last year's $7 million. Since CVR Partners is a master limited partnership, it stands to pay out a lot of its earnings in the form of distributions. This makes it an even better buy in the agri-tech sector. The company has a splendid forward dividend yield of 16.26%, with a payout ratio of 42.09%. CVR Partners' latest cash distribution took place on August 22, with a cash of $10.05 per common unit. With no resolution to the Russia-Ukraine crisis in sight, the fertilizer sector is only expected to continue making huge profits. Therefore, CVR is well positioned to further improve its bottom line and hence its payout. This means double profits for its owners. Up next is another company that manufactures fertilizers, CF Industries Holdings Incorporated, trading under the ticker symbol, CF. CF Industries is a major producer of nitrogen and phosphate fertilizer products throughout the world. It also creates compound fertilizer products that include phosphorus. Based in the U.S., CF Industries is a $20.28 billion corporation that runs operations in Canada, Great Britain, and Trinidad, in addition to the U.S. On one hand, the higher natural gas costs and energy crisis in Europe have proven to be headwinds for the company, forcing it to halt production in one of its two nitrogen plants in the UK. But the rising nitrogen fertilizer demand, and higher prices due to its shortage, are proving to be the much-needed tailwinds to drive growth. Amid such market conditions, CF Industries, however, is well placed to benefit, as the global nitrogen supply-demand balance is expected to remain tight for the foreseeable future. The company also boasts high margins and a strong balance sheet, with reduced long-term debt and a firm cash position. In the latest earnings report, CF Industries generated sales of $3.38 billion. This figure is well ahead of last year's sales of $1.58 billion. Moreover, net earnings grew nearly five-fold year-over-year in the quarter. If that's not enough, the company also has a net margin of 25.28%, much above the industry median of 6.94%. Additionally, its return on equity is nearly 12 times the industry median of 12.01%, at 71.41%. All in all, CF Industries' financial and fundamental position is very firm, and the company is well placed for capitalizing on the tailwinds in the sector. And the last stock on our list for today is one of the largest seed and crop protection companies in the world, Corteva Agriscience, trading under the ticker symbol, CTVA. Corteva enhances crop health by protection from weeds, diseases, insects, and other pests. The company recently partnered with BASF Agricultural Solutions for developing future herbicide-tolerant soybeans. Corteva has a significant margin expansion opportunity due to many reasons. Firstly, it has been cutting costs and selling more products under its own technology, instead of royalty payments to others for complementary products. Its Enlist crop protection system has been planted on 45% of U.S. soybean acres in 2022, which will give it a big pickup to its profit margin in the years to come. Inflation has forced the company to cut costs by exiting some markets and executing 5% layoffs. However, this will help the company focus on its core countries, as it exits the non-core ones which make less than 5% of its annual revenue. Moreover, its sustainable price increases and shift to higher margin, premium products are proving to be a catalyst aiding in both sales and profit. In the second quarter of 2022, it was able to raise net sales by 11% year-over-year, to $6.25 billion. The adjusted operating earnings rose 17% year-over-year, to $1.64 per share. Due to the quarter's strong performance, Corteva raised its full-year guidance to be somewhere between $17.2 billion and $17.5 billion in sales. Generating consistent profits is only expected to provide the company with the potential to add long-term value to its shareholders. Hence, it is most certainly a great agri-tech stock to buy right now. And with this, we reach the end of our today's video. We aim to deliver you meaningful information on the best agri-tech stocks for your investment portfolio. We hope you were able to gain some helpful insight from the knowledge we provided. We would love to hear your thoughts on our list in the comments section below. If you would like to know more about different stocks and investment strategies, do check out our website, stockstelegraph.com.